Alright guys, welcome back. So in the previous video, we completed the cost computations and fixed assets and depreciation computations. And in the end, we linked whatever we have computed to our financial statements. So let's continue the case study further and let's see what all do we need to compute in this video. So, looking at the case study, the next section is working capital. And the question says, based on the historical data, please make reasonable assumptions for the working capital days over the next 5 years. That means now the question doesn't tell us that, okay, this is what you need to consider for the future. It allows this flexibility to us, the professionals, while making the financial model, to consider whatever you find it is correct based on the historical data. So as it's very evident from this, we need to compute what were the working capital days in the historical years. So let's see that. The next section, working capital assumptions. Let's see how many types of working capital do we actually have. Okay, what are the components of working capital? So going to the balance sheet, current assets, okay, leave alone cash and cash equivalents. We do not include cash and cash equivalents while computing the working capital components. Why? Because that balance of cash comes from our cash flow statement only, right? So we are not required to compute this cash balance as a percentage of something or not, right? So the first is accounts receivable. So let's just go to the input sheet and link days of accounts receivable. Then what do we have next? We have inventories. So days of inventory. Next, other current assets. Days of other current assets. Fair enough. Do we have any other current asset? No. Okay, let's look at current liabilities. Leave alone revolver. This is a part of debt. We'll come to debt computations. Apart from this, we have two types of current liabilities: accounts payable and other current liabilities. So let's say days of accounts payables and days of other current liabilities. Okay, and this is the unit is days of revenue. So the unit for accounts receivable will be days of revenue. We know that we compute the receivables based on revenues. Inventories, days of cost of goods sold or cost of sales, as in this example. Other current assets, days of revenue. Accounts payables, days of cost of sales, and other current liabilities also days of cost of sales. Okay, now if I take you back to your academic days where you were studying ratios, we have a set of ratios known as turnover ratios, and within those turnover ratios there was one debtor turnover ratio or accounts receivable turnover ratio. Don't write, just listen. Accounts receivable turnover ratio. Now what was the formula for this? This was your revenue divided by average accounts receivable right? Revenue divided by average accounts receivable. That was the formula, correct? Now, if I have to compute, this number in days now, if I have to compute days of revenue, so the formula is days of accounts receivable. The formula is 365 divided by accounts receivable turnover ratio. So days of accounts receivable is what? 365 divided by accounts receivable turnover ratio. Okay. So now there are two ways to do it. Either you compute turnover ratio first and then divide 365 by turnover ratio, or you can do it in a simple computation as well, simple formula as well, and this will become what? 365 divided by average accounts receivable, 365 multiplied by average accounts receivable divided by revenue, right? This is what the formula will become. So let's see how. This is revenue and accounts receivable. So revenue over average accounts receivable will give you turnover ratio. Now, when I am computing days, 365 over revenue over accounts receivable, right? If this is the formula, that 365 divided by revenue divided by accounts receivable, so what will happen? This average accounts receivable will go to the numerator and get multiplied, right? That's how we do it, right? Just applying a little bit of mathematics to it. So it becomes what? 365 multiplied by average accounts receivable divided by revenue, right? Now, keeping this formula in mind, let's see. Now, if I do this for 1st January 15 to 31st December 15, can I write can I find out the days here? No, I cannot. Why not? Because what is the formula? Average accounts receivable. For finding out the average, I would be needing the opening balances as well. That is, I would be needing the balances of the previous years as well. But I don't have any number for 2014. So I cannot compute for 2015. So what I will be doing is, I will start this from 2016 onwards, right? And what will be the formula? 365 multiplied by average, 365 multiplied by average, and average of what? Average of accounts receivable. So opening and closing, average of accounts receivable, I will be selecting 15 balance and 16 balance, close the bracket here, divided by revenue, so in your financial statements you already have revenue, right, for 16. So you get 1.5. All right, you get 1.5. So 1.5 days of revenue is tied up in your accounts receivable. Similarly, I can do it for 17 as well. So I just need to copy the formula. right? Now, what assumption can I make going forward? Let's assume going forward, I I am doing slightly, let's take this assumption of having 2 days of revenue going forward. You are free to take your own assumptions. You can keep it at 1.6 also, saying that okay, most recent year has 1.6, so I can make it 1.6 carrying forward. Or you can also say, okay, what is the average? Average is 1.5 in the historical year, so let me keep it at 1.5 only. You can do that as well, right? So you are free to make those assumptions. Okay, inventories, same way, 365 multiplied by average inventories this time. Average inventories. Now, where are inventories? Here it is. So average inventories divided by cost of sales this time. So put a minus and then link cost of sales. 99 days. Similarly, I do it for 17, 94 days. So let's say I say, okay, let me keep this as the most recent historical year. So let me keep it constant for the most recent historical years. So I've shown you both the methods, one in which you take the assumption, otherwise you can link from the most recent historical years as well. Days of current assets. Days of current assets. Now, let's say other current assets also, you keep it on revenue. Let's say you keep it on revenue. Now, $365 multiplied by average other current assets divided by, again, revenue. So 11.4 days. Now what you can do is you can, instead of taking other current assets on revenue, I can take it as cost of sales only. Why? Because I am saying that if my other current liabilities, the base is cost of sales, right? Then for other current assets also, the base should be cost of sales only, right? So let's take days of cost of sales only. So instead of revenue, I link it to K10 and put a minus sign here. Keeping it the same as the most historical years. Days of accounts payable, do it the same, 365 multiplied by average accounts payable, here it is, divided by cost of sales. Similarly, days of other current liabilities, 365 multiplied by average other current liabilities and divided by cost of sales. Right, so just check if your linking is correct. Okay, so days of other current liabilities, so it has to be other current liabilities. See here what has happened, I have linked it to other current assets by mistake. right? So just avoid this these careless mistakes from your end, and be very very careful when you are linking. Okay, so I just wanted to show you this. So be very careful. So 365 multiplied by average other current liabilities divided by cost of sales. So 10.46. All right. So these are my assumptions for working capital. Right now you might be wondering, how can you take these assumptions? So this is based on your research. Okay, what is the historical trend, how are the competitor firms performing? So that all this analysis you have to do. Okay, for getting at this number. Fair enough. Now we are to prepare a schedule, and you know the drill. It's very simple. Copy the template sheet across, and this is working capital computations. Now bring in two figures from your financial statements. One is your revenue, one is revenue 18 onwards, other is your cost of sales, again 18 onwards. Okay, now after you link this, bring in all the assumptions that we have framed for working capital and working capital components from the input sheet. Get all these assumptions from the input sheet. Link it across. And check the formattings. Okay. Now I have made the assumptions for days of accounts receivables and days of inventories or whatever. I have the number in days. I have the total amount for the base also, revenue and cost of sales. So can I find out the amount of accounts receivables in millions of dollars? Can I do that? How can I do that? It is very very simple. This figure of revenue, is this for 365 days? Yes. Out of which 2 days are tied up in accounts receivable. So applying a very very simple method, the unitary method, I can get to the computation that revenue multiplied by 2 divided by 365. Simple. I can get to these amounts. So this is my amount for accounts receivable. Similarly, let's find out the amounts for inventories in millions of dollars. Again, the base should be cost of sales now. Cost of sales multiplied by 94.8 days divided by 365. Now you might be wondering, why am I again and again writing down 365 when in the first session when we were talking about modeling and attributes of good modeling, we said minimum hard coding. So very good. So this should be avoided. Definitely it should be avoided. So what should you do if you need to avoid 365 again and again? So if you want to avoid typing down 365 manually again and again, then what should you do? Let's see. I'll remove the receivables also. Come to the input sheet, please. Come to the input sheet when you were writing down the model assumptions, just add some lines to it and write down days in a year. Write down days in a year and just write down 365. Just write down 365 as an input. Okay, just do this change. Now I want to do my computations taking in mind 365 days in a year. Okay, so how should I do it? I link it here, I write it here once, 365 days, right? So days in a year is 365. Now, where can I see the name of this cell? Be very, very attentive here, guys. This is something very, very important and very, very essential for financial modeling. Where can I see the days, where can I see the name of this cell? In the name bar. Now this is the name box. Just towards the left of your formula bar, you can see the cell name. It is F14 as of now. This one, F14. So simply delete it and write down days and press enter. Simply delete F14 and write down days. Okay, so now when I come to this cell, instead of F14, now what can I see? Days here. Now you'll ask me, okay, but what does that help me with? Now the the benefit of doing this is, whenever I will write is equal to days here and press enter, it will give me 365. Because now for this entire workbook, days means 365. Wherever I'll write is equal to days or use days in a formula, I have specifically told Excel that days means 365. Now, if you have understood this, come back to the working capital computations. Come back to the working capital computation. And what did we say? While computing accounts receivables, revenue multiply by 2 days divided by 365. Now instead of 365, I can simply write days and press enter. So the formula will automatically take 365, right? So I have removed my hard coding problem as well. Similarly for inventories, cost of sales multiplied by 94.8 days divided by days, which is my 365. Similarly, days of other current assets, compute the amounts in millions now, please. Multiplied by 9.4 days divided by days. Days of accounts payable, same thing, cost of sales multiplied by accounts payable days divided by 365. Guys, I hope you are not copying and you are trying to do it on your own. I know this is something which is repetitive in nature, but let's just do away with this and move to taxation. Days of other current liabilities. All right. Now these are my numbers. So I have appropriately computed my numbers in millions now. So I can link it to the balance sheet. So just go to your financial statements in the balance sheet, accounts receivable, just link accounts receivable to the number that you have computed. Similarly, inventory, and similarly, other current assets. Link these three and just drag ahead the formula. So for accounts payable, I link it to accounts payable, drag it ahead, and similarly for other current liabilities. Okay. Now, one more area where working capital is of utmost importance. What is that area? Cash flow statement. So we need changes in working capital. So let's compute the working capital. So current assets, current liabilities, and what I will get is my working capital. So of course in millions. So current assets is accounts receivable plus inventories plus other current assets, and current liabilities is payables and other current liabilities. So working capital is current assets minus the current liabilities. Here we go. Now I need change in working capital. Now I need change in working capital. Now how will I do change in working capital? It's very simple. Current year minus previous year. Current year minus previous year. But for this 2018 to give me a correct answer, I need the numbers for 2017 as well. Then only I'll get the change. So I need current assets for 2017. So I'll just link from the balance sheet. Current assets for 2017, receivable, inventory and others, and current liabilities for 17 again, it is payables and other current liabilities. Okay, that's it. So now you have change in working capital as well. Now, to link this change in working capital to your cash flow statement, will it be a positive sign? Will it be a negative sign? It will be a negative sign. Why? Because we have discussed earlier that whenever there is an increase in working capital, I take it as a cash outflow, right? So in my cash flow statement, where there is change in working capital, I will take it as a negative number. I will take it as a negative number. Okay. I will take it as a negative number. That's all. That's all regarding working capital. So we are done with working capitals. Now let's go back to the case study again and see the next segment of income taxes. We are being told that the company's tax rate is 28%, and we are also being told that it is expected that the company's pre-tax income for government purposes will be $40 million lower than the pre-tax income for accounting purposes every year due to temporary timing difference, which means, now I don't know how many of you are aware or not, but there are certain items which you subtract to arrive at the net income for accounting purposes. Some of these deductions are disallowed from taxation point of view, right? So if the government disallows certain deductions, so there will always be a difference between the net income from accounting perspective and the income from a taxation perspective. The pre-tax income I'm talking about, the profit before taxation, let's say, right? There will always be a difference. So if there are certain items due to which certain of my deductions are disallowed, and hence there is a difference between these two, there will be certain taxation which would be deferred in nature. Those are known as deferred taxes, right? So let's create a separate schedule, or before that let's put in the taxation assumptions. Taxation assumptions. So the tax rate is given to be 28%. The tax rate is given to be 28%, and temporary timing difference is given to be $40 million. So we know that for taxation purposes, my income is $40 million lower than the accounting purposes. So now we need to create a separate schedule. So copy the template sheet and create a tax schedule. Let's quickly create a tax schedule. Okay, let's quickly create a tax schedule. Now there are two components of taxation that we need to take care. One is the current taxes or current tax expense, and the other is, so one is current tax expense and the other is deferred tax expense. So current tax expense is whatever is your net income for government purposes, for taxation purposes, you apply the tax rate and you get your current tax expense, right? But there is a separate computation of computing the deferred tax expense. Okay, so let's see. Let's compute current tax expense first. Now let's bring in from the financial statements, let's bring in your EBT, let's bring in EBT, earnings before tax. And we know that for taxation purposes I have a $40 million of a difference, right? So the income from taxation purpose is $40 million lower than the income for accounting purposes, right? So what is the pre-tax income from accounting perspective? This is what it is, which is there in your income statement. What is your temporary difference? $40 million from your input sheet. So what is your taxable income? How much will be your taxable income? So just write down the heading for this: computation of taxable income. So this is your taxable income. Very simple computation. Just reduce $40 million. So your EBT minus your $40 million and do a column freeze. So you have to apply an if statement here. If the year of this end date is greater than 2017, then give me what? Give me EBT minus $40 million, otherwise give me 0. Right? Otherwise give me a 0. So I'll just open up the formula for you. Complete till this point. Okay, this is very simple, right? It was given to us very clearly that income for tax purposes is $40 million lower than the pre-tax income from accounting perspective. Okay, fair enough. So this was taxable income. So this is computation of tax expense, current tax expense. So I have taxable income computed here. Taxable income is computed here. Tax rate I have from the input sheet. Tax rate I have, row freeze, from the input sheet. So can I compute the current tax expense? Simple. Taxable income multiplied by 28%. I arrive at my current tax expense. Okay. This is one part to my computation. The next part is computation of deferred taxes. Computation of deferred taxes. Now, deferred taxes is the difference between the current taxation, the current tax expense, and what would have been the tax as per accounting computations, right? So let's compute computation of taxation for accounting. What would have been the tax for from accounting perspective? Very simple. EBT. I link EBT. So if you have freezed it earlier, you would have simply copied the row. Otherwise, you do this. EBT. I have the tax rate 20%. I can simply compute the taxation for accounting. Again, EBT multiplied by 28%. Now, computation of deferred taxes. I have taxation for accounting. I have current tax expense. So I can get deferred taxes, deferred taxes, simple, tax for accounting minus current tax expense. This is the tax that I am deferring. This is the tax that I am deferring, and this will be paid by me once this temporary differences recover. So, this is the concept in accounting of deferred taxes. So, you can study this concept first, and then you will be in a probably a better position to understand this computation, right? I don't want to take you into deferred taxes in this model, otherwise you will be confused. So do remember to refer to the concept of deferred taxes in accounting standards. Okay. So current tax expense we have computed, deferred taxes also we have computed, and I need no other computation on this. So end of sheet. Now in the financial statements, I will link the current taxes that I have just computed. So I link the current taxes. I link the deferred taxes as well. I link the deferred taxes, and I arrive at my net income except interest expense. So interest I am yet to compute, so I have just highlighted it as of now. Okay. Reach till this point. So I'll give you some seconds off. Now, if you are done till this point, let's do one more computation as a part of this video, and let it be the equity computations. Okay, let it be the equity computation. So what do we have in equity? We are given that the company plans to issue 50 million of preferred equity at the beginning of 2018 that will pay an 8.5% of preferred dividend. Right? So you are going to issue preference shares amounting to $50 million in 2018, and the preference dividend rate is 8.5%. Then the common dividend policy states that the company's common dividend means dividend to the equity shareholders, the common stocks, right, and not the preferred stocks. So the common dividend policy states that the company's common dividend will be based on a payout ratio of 20% to net income to the common each year. Okay. We are also given that the company plans to spend $200 million on common share repurchases in 2018 and $50 million per year thereafter. What do we mean by common share repurchases? This is nothing but your share buyback. So what happens? Sometimes when the company has access cash, when the company has certain cash in hand, the company purchases its own shares from the market, right? This helps the company to retain the control. So the company, when purchases the shares from the people, from the market, that are known as buyback of shares, or share buybacks, or common share repurchases. Okay, so let's put these assumptions in input sheet. Let's put the equity assumptions. Equity assumptions. issue of preference shares, millions of dollars, and you are given what? 50 million, and 0 after that. So 50 million, the company will issue preference shares in 2018. Okay. Then preferred dividend. Dividend was 8.5%. The dividend was 8.5%. Okay. Then equity shares buyback. How much I am buying back? So in 2018, 200 million, and thereafter it was 50 million. Was that the assumption? Let's see. 200 million in 2018 and 50 million thereafter. Perfect. So shares buyback, 200 million in 18 and 50 million thereafter. And common dividend rate was 20% of what? Net income to common. 20% of net income to common. So this is also percentage. So now we need to prepare a separate computations, a separate equity schedule. So you know the drill. As and when I say that we need a separate schedule, you know what to do. You will copy the template sheet. Copy the template sheet, please, and rename it as equity, alt HOR to rename. Rename it as equity. So first computation would be preference shares and preference dividend. First computation, preference shares and preference dividend. So let's first compute the ending balance of preference shares. How can I prepare the ending balance of preference shares? How can I get to the ending balance? Of course, we will have some beginning balance. I will add what? Shares issued during the year. I will subtract shares, preference shares redeemed, and I will get to the ending balance. In millions of dollars. So do we have a beginning, do we have an ending balance for 2017? Let's link it from the financial statements. So preference shares, it is 0. So if it is 0, then the beginning balance next year will also be 0. So I can link the beginning balance to the closing balance of the previous year. Shares issued during the year, I have it from my input sheet. Preference shares redeemed, it's 0. Just you can enter 0, and the formula is beginning plus issued minus redeemed. Okay. So just do this computation, as simple as that. Reach till this point. Ending balance of preference shares. Now since we have the ending balance of preference shares, this needs to get linked to the financial statement. So let's link it later. Let's complete this first. Now let's compute the preference dividend. Computation of preference dividend. We have the ending balance. We have the ending balance of preference shares here. Let's link from the input sheet the preferred dividend rate. And that's it. I just multiply the two and I get the preference dividend. In millions of dollars multiplied by 8.5%. So that's it. I have computed now ending balance of preference shares as well as the preference dividend amount. All right. So now let's see where all we can link these things that we have computed. So ending balance of preference shares, I need to link it to the financial statements. So preferred shares in the balance sheet will now be linked to my computations. Be very, very careful when you're linking, guys. Okay, that is one. In my income statement, after the net income, I had a line item where I needed to enter the preferred dividend as well. So I'll link the preferred dividend and I'll compute what is my net income to common shareholders. Okay. Okay. Let's look further in the cash flow statement. Do we need to connect something regarding preference shares? Yes. So preference shares issued. Okay. I link it as preference shares issued during the period, which is 50. Preferred dividends as an outflow in the financing activities. So I also have preferred dividends. So that was all that I could have linked till now. Fair enough. Go back to the equity schedule. That's all regarding preference shares. Now, the next computation is equity shares and equity dividend. Right? Equity shares and common or equity dividend. First, I need to do the exact same thing. I need to compute the ending balance of equity shares. How will I compute? I might be having some beginning balance of equity shares. Add equity shares issued during the year. That increases my equity balance amount. Any share that I am issuing during the year, that will increase the balance of my share capital, that will increase the balance of my equity shares. Then less shares buyback, something that I am buying back, or shares repurchases, and this will give me my ending balance of equity shares. Everything in millions of dollars. Do we have an ending balance of equity share for 2017? For sure. It will be there for sure in your balance sheet. Common shares. Fair enough. Okay. Now, this ending balance will become my opening balance in the next year, right? You know how to do it now. Do we have any equity shares issued during the period? No. Do we have any shares repurchases? Yes, we do. So 200 million. And the formula for ending balance: opening plus issued minus repurchases, ending. Complete till this point. This will give me the ending balance of equity shares. The next computation is common dividend. Guys, I really hope you are able to catch up. There are a lot of computations that we are doing. You might have started to get the feel of financial modeling by now. Common dividend. Now, how can we compute the common dividend? If you remember, this was 20% of the net income to common. So shall we link it to net income to common? Yes. Where is net income to common? Here it is. So net income, I subtract the preference dividend. Now whatever I have is the net income which is attributable to common shareholders, which is attributable to common stockholders, right? Net income to common. Then what is the rate? 20%. And that's it. Common dividend in millions is simply your net income to common multiplied by 20%. Now, that's it regarding equity shares and equity dividend. So let's see, where all can I link this equity share balance and common dividend balance? Let's see. In the financial statements, let's look at the cash flow statement. And I know that in the financing activities, I would be required to mention common shares issues or buybacks. So I don't have issues, but I definitely have some buybacks. So these shares repurchases and common dividends as well. Whatever is the amount of common dividends. Coming on to the balance sheet, common shares. I have the ending balance of common shares now. Perfect. Fair enough. Now, equity schedule is not over yet. Why not? Because we still have one element of shareholders' funds that we haven't yet computed, and which is known as retained earnings. You might have heard about reserves and surpluses. This is what retained earnings, right? So how can I compute the ending balance of retained earnings? Same schedule. So let me just do one thing. Let me just copy this schedule from here, and I'll just change the wordings. Okay, so this will become ending balance of retained earnings, beginning balance of retained earnings, add. Now what will increase the retained earnings? What will increase my retained earnings? Now we know that whatever is the net income in the income statement, where do I take that net income? That goes on to become the part of retained earnings, right? So my retained earnings will increase by the amount of net income, right? So whatever is the net income, I will add it and subtract my common dividend, right? Now what is the balance, ending balance of retained earnings in 2017? Your balance sheet minus 343. What is the net income to common? $474.3, and so on. What is your common dividend? You just have computed above. So you arrive at your ending balance of retained earnings. Again, do check the formula, guys. If you are subtracting the common dividend and showing it as a minus here, your formula should be correct in that case. And that's it. Retained earnings. That's it. My end of sheet. Now I can link the balance of retained earnings to the balance sheet now. Simple linking of the balance of retained earnings. Okay, so we have come a long way now. We've done our working capitals, we've learned how to compute the current taxes, deferred taxes, how do we compute the equity schedule, right? And we have linked everything to the financial statements. Now I am not planning to move ahead in this video, guys. I know that's a lot to cover. So let's take a halt here. And in the next video, let's complete the financial statements. We are left with debt schedule. That's it. And we'll just link everything in the financial statements. So in the next video, we'll complete the financial statements. And then after that, we'll start with the dashboard. All right. So I look forward to seeing you in the next video, guys. All the best with this.